Welcome back to Iron Financial. Our mission here is simple: to help you forge a stronger, more resilient portfolio. We do that by cutting through the market noise, hammering out the facts, and stress testing a company's financial foundation. Today, we are putting Scholastic Corporation under the microscope. They just dropped their third-quarter earnings, and the numbers have created a paradox, a real head-scratcher that we need to break down piece by piece.
Okay, let's just dive right into the heart of the matter. This is the central mystery we need to solve today. The headlines, if you just glanced at them, screamed that Scholastic absolutely crushed its earnings per share forecast. We're talking a positive surprise of 75%. Now, in a normal world, by any conventional logic, that's the kind of news that should send a stock soaring. But what happened? The market took one look and started selling, pushing the stock down over 4%. Now, that's not just a minor blip. That's a serious disconnect between the headline number and what investors actually believe. The market is whispering to us that there's more to the story, that there are some cracks just below the surface. Our job today is to find them.
Exactly. I mean, I'm looking right at this, and the two sides of the screen just don't compute. It's like they don't belong in the same story. On one side, you have this massive 75% earnings beat. That's a number any CEO would be shouting from the rooftops. But then on the other side, you have a 4.16% drop in the actual stock price. The market clearly is not buying the hype. It's sniffing out weakness somewhere else. So the real question, the one we have to answer, is what is the market seeing that this big, shiny EPS number is hiding? Is the foundation of this company truly solid? Or is this just a fresh coat of paint on a crumbling, rusting structure?
That is precisely what we're here to determine. So here's our financial blueprint for today's analysis, our plan of attack. First, we'll start by dissecting the paradox itself. Then, we're going to get our hands dirty. We're going deep inside the operating engine, looking at the performance of each individual business segment. After that, we'll analyze the massive $400 million shockwave that just slammed into their balance sheet. We'll then examine how they're deploying that capital with what I'm calling the buyback cannon. From there, we'll look at how they're trying to use all this to forge a new foundation with brand new financial targets. And finally, after all that, we'll deliver our verdict. Let's get to work.
All right, Section 1, the Scholastic Paradox. This is where we start peeling back the layers of the onion. You've got these headline numbers pulling in two completely different directions, and that creates confusion. Confusion leads to uncertainty. We're going to examine the cracks in these numbers, figure out why a supposed victory on paper looked like a clear loss to the market. So, let's get right into the data.
Now, what's really interesting about this slide is the tension it shows. Just look at the top line, revenue. They brought in $329.1 million. But, and this is a big but, that was a miss. The forecast, what Wall Street was expecting, was over $331 million. It's not a catastrophic miss, less than 1%, but it's a miss nonetheless. It signals weakness. But then your eyes drift down to the bottom line, EPS, earnings per share, a loss of 15 cents per share. Now that sounds bad on its own, but the forecast was for a loss of 60 cents per share. So they lost far less money than anyone expected, and that's what created that massive 75% positive surprise. The market completely ignored the big beat and keyed in on the tiny revenue miss. Why? Because you can manage earnings. You can cut costs, you can delay spending, you can use accounting tricks. But revenue? Revenue is the lifeblood of a company. It tells you about pure, unadulterated demand for your product. A revenue miss, even a small one, signals that the core business is weaker than expected. And that's a fundamental problem that spooks serious investors every single time.
And that weakness in the revenue, that little crack, forces us to move on to Section 2. We absolutely have to look inside the operating engine. A company is only as strong as its core businesses, so we need to pop the hood, get in there, and inspect each segment to see which parts are firing on all cylinders and which ones are sputtering and leaking oil. We're looking for the load-bearing walls of this company and for any potential structural faults that could threaten the entire enterprise.
And right away, this table confirms those fears. I'm seeing a lot of red flags here. This isn't one isolated problem. The weakness is widespread, it's systemic. Children's books and distribution, which is their biggest segment by a country mile, at nearly $200 million in revenue, is down 3% year over year. Education is down 2%. International is down 1%. I mean, almost the entire operational base of this company is shrinking. The only bright spot is this little entertainment division of 25%. But look at the scale. It's only $16 million. That's a rounding error compared to the core business. So you're telling me the main engine is stalling out almost across the board? Where is all this supposed strength supposed to be coming from?
That is a fair challenge. And to answer it, we have to go one level deeper. Inside that big children's book segment, because it's not monolithic. It's really two different businesses, and this chart brilliantly illustrates the internal tug-of-war going on. On one hand, you have the book fairs business. Revenue there was actually up 2%. This is a solid pillar of strength for the company. It's a resilient, unique distribution channel that continues to show incredible durability. But then, on the other hand, you have the trade publishing division. That's your traditional bookstore sales, your Amazon sales, and that business is down a jarring 10%. So right inside their most important segment, you have one part that's holding strong and another part that's got some serious cracks forming.
So the crucial point here, the thing you have to understand is the why behind these numbers. Book fairs are up to $113 million because they're simply getting more money out of each fair they run. That shows good operational execution, plain and simple. Trade publishing, however, is down 10% largely because of timing. The quarter they're comparing to last year had a major Dogman release, which is a blockbuster, a monster franchise for them. This quarter just didn't have that. The education segment is weak because, well, school district spending is tight across the country right now, and entertainment is that small but powerful little growth story we saw. Okay, I see the reasoning on the Dogman release, but that feels like a problem in itself. If your business swings this hard based on one author's publishing schedule, that feels like a pretty fragile foundation. And you can't just brush off weakness in the education sector as softness. That's a core market facing real, tangible funding uncertainty. How sustainable is the strength in book fairs if the other major divisions are facing these kinds of serious structural headwinds? It really does feel like one strong pillar is trying to hold up a sagging roof.
And that concern, that image of a sagging roof, is precisely why management felt they had to make such a dramatic, earth-shaking move. Let's move to Section 3 and see how this builds. Look, the operational weakness we just detailed isn't some secret inside the company. Management saw the stagnation, they understood the headwinds, and they decided they couldn't just sit back and wait it out. They needed a shock to the system, something big to completely recast the company's entire financial foundation. And that, my friends, is the $400 million shockwave.
Just look at that number. Over $400 million. Just let that sink in for a second. That is the net proceeds, the cash, the company generated from a single set of transactions. This isn't profit from selling more books. This is a massive, one-time injection of capital that fundamentally changes the entire company's financial position, literally overnight. A number this big demands our full attention because it's the pivot point for the entire story we're telling today.
Okay, hold on a second. $400 million doesn't just appear out of thin air. How did they get it? This slide says sale-leaseback. Can you break that down in simple terms for me? Because to my ear, it sounds like they sold their own headquarters. Did they just sell off the company's core assets, the crown jewels, just to generate a pile of cash? Is this a sign of desperation because the core business is sputtering and they needed money, fast?
It's a completely valid question, and the simple answer is yes. They did sell their New York headquarters and another facility, and then they signed long-term leases to continue operating in those same buildings. But the reason they did it is staring us right in the face on this slide. Just look at this balance sheet transformation. At the end of fiscal 2025, just a few months ago, Scholastic was in a net debt position of $136.6 million. They owed more money than they had in the bank. Now, after this transaction, by the end of this quarter, they have flipped to a net cash position of $90.6 million. In one single move, they erased over $220 million in net debt. They went from being in the red to being firmly and comfortably in the black. This isn't desperation. From management's point of view, it's financial fortification. They just built a fortress of cash.
A fortress built on rented land. That's the catch, isn't it? This cash isn't free. They sold an asset that they owned outright, an asset that generated no rent expense, and now they have to pay rent on it, forever. And right here, this slide shows us the cost. A $14 million annual hit to their adjusted EBITDA. That's a new, recurring expense that is going to drag on their profitability every single quarter, every single year from now on. So they traded a one-time cash infusion for a permanent increase in their operating costs. That seems like a very, very expensive trade-off, especially for a company whose revenues are already flat.
It is a significant trade-off, and you're absolutely right to point it out. But now we have to look at what they're doing with all of that newfound financial firepower. And this brings us right to Section 4, unleashing the buyback cannon. Management didn't just take that cash and let it sit on the balance sheet to collect dust and earn a little interest. No, they immediately announced a massive $300 million plan to buy back their own stock. This isn't just some minor financial maneuver. It's a powerful statement. It's management making a huge public bet on itself.
So the crucial point is understanding how they're deploying this capital. The $300 million authorization is broken into two distinct parts. The first, and by far the largest, is a $200 million tender offer. This is an aggressive, front-loaded move designed to take out a huge chunk of shares very, very quickly.
The remaining $100 million is for more traditional open market repurchases that they can execute over time. This two-pronged approach signals both urgency and a long-term commitment to returning this new capital directly to shareholders.
Okay, let's talk about this Dutch auction tender offer. How does this actually work? And more importantly, why do it this way? It seems awfully complicated. Why not just go into the open market and buy $300 million worth of stock like most other companies do? Is this some kind of financial gimmick designed to artificially prop up the stock price? It's not a gimmick. It's a tool designed for speed and efficiency. Think of it like a reverse auction. The company sets a price window, and in this case, it's $36 to $40 per share. They're essentially telling the market, we believe our stock is worth at least this much. Then, any shareholder who wants to sell can tender or offer their shares, and they state the minimum price they'll accept within that range. The company then starts with the lowest priced offers and works its way up the ladder until it has spent the full $200 million. The huge advantage here is that it allows them to retire a massive number of shares, potentially up to 25% of the entire company in a very short period, without driving the price up against themselves like a huge open market purchase inevitably would.
And as for the why, well, let's just look at the CEO's own words. Peter Warwick said this move underscores our confidence in Scholastic's long-term opportunity. This is not a defensive move. From management's perspective, this is the ultimate signal of conviction. They are taking this enormous pile of cash, and instead of acquiring another company or investing in some risky new project, they are investing in their own shares. They are telling you, the investor, that they believe their stock is fundamentally undervalued by the market, and they're using their freshly fortified balance sheet to prove it in the most direct way possible.
Okay, let's move to Section 5 and see how all of this builds into a new strategy. All of these actions, the sale-leaseback, the balance sheet reset, the massive buyback, they are not just isolated events. They are the components, the building blocks, of a new, more aggressive financial foundation for the entire company. We need to synthesize these moves and understand what the go-forward strategy really looks like.
And this right here brilliantly illustrates the long-term plan. The company has established a brand new long-term target for its net leverage ratio, 2 to 2.5 times its adjusted EBITDA. Now let me be crystal clear. For this company, this is a major philosophical shift. For years, Scholastic was a very conservative company, often carrying very little debt. By setting this target, they are signaling a permanent move to a more optimized, more aggressive capital structure. They are telling investors that going forward, they plan to use debt strategically to fund growth and shareholder returns, rather than just hoarding cash on the balance sheet.
A more aggressive structure on a flat business. That's the disconnect for me. That's the part that doesn't add up. I'm looking at their reaffirmed guidance for the full year, and growth is not the word that comes to mind. They're guiding to approximately flat revenue. After all this financial engineering, all this wheeling and dealing, the core business isn't expected to grow at all this year. And their adjusted EBITDA guidance of $146 to $156 million explicitly includes that $14 million drag from the new lease payments. So what happens if the softness in education gets worse? Or if the next Big Dog Man book gets delayed again? What are the real headwinds that could derail even this no-growth target?
You're absolutely right to be skeptical, and the risks here are significant. We have to acknowledge them head-on. First, as you've pointed out multiple times, are the higher operational costs. That $14 million lease payment isn't a one-time thing. It's a permanent drag on profitability. Second is the core issue of revenue stagnation. Financial engineering cannot fix a no-growth top line forever. Third is that continued softness in the education sector. If school funding doesn't rebound, that segment could continue to struggle or even decline further. And fourth, there's an expected $10 million hit from tariffs on their cost of goods. These are not minor issues. They are serious structural risks that any potential investor needs to monitor very, very closely.
This brings us to the final section, our verdict. We've examined the paradox, we've inspected the engine, we've analyzed the balance sheet shockwave, and we've assessed the new foundation. Now it's time to bring all the evidence together and answer the fundamental question. Is Scholastic at this moment an opportunity, or is it a trap?
The bull case is clear, and it's built entirely on financial strength. The company now has a fortress balance sheet with a strong net cash position. They are executing one of the most aggressive shareholder return programs in their entire history. The book fair's business remains a resilient and powerful cash-generating asset. And management is signaling extreme confidence with its massive buyback. It's a really compelling argument for value. But the bear case is just as strong, maybe even stronger, and it's built on operational reality. The core revenue is stagnating, it's not growing. They've locked in higher long-term costs that will eat into profits forever. Key segments like education and trade publishing are showing significant, undeniable weakness.
You can easily argue this entire bull case is built on financial engineering, not true operational improvement. It feels like they sold the house to buy a fancy new car, but the engine is still sputtering. And that, my friend, is a trap.
After weighing all the evidence, our verdict here at Iron Financial is this. Scholastic has built a fortified base, but it sits on very shaky ground. The financial maneuvering has been impressive, I'll even say bold. They've created a rock-solid balance sheet and now have the firepower to significantly reward shareholders and shrink their share count. They have absolutely de-risked the company from a balance sheet perspective. However, they have not solved the fundamental problem. The core operating engine is not growing.
So the crucial question we leave you with is this. Has Scholastic, through all this incredible financial heavy lifting, simply bought itself time to fix its sputtering operational engine, or have they just applied a shiny new coat of financial paint to a frame that's still rusting from the inside out? Moving forward, here's what you need to watch. First, revenue per book fair. Does that key metric hold up or start to decline? Second, look for any commentary on the education segment's order book. Is there any sign of a turnaround coming? And third, watch the trade publishing schedule. What's in the pipeline beyond the next big hit? Because the company cannot shrink its way to greatness. The heavy lifting on the operational side is just beginning. That's the question investors must now answer. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.